Advanced Financial Modeling, Topic 9, Forecasting Financial Statements, Free Cash Flows, and Stock Valuation. Learning Objective Number 5. We're going to value stocks using relative value analysis and price multiples. So let's talk about price multiples and comparables. Using price multiples like the PE ratio and comparable firms is like valuation in residential real estate, valuing homes. You look for the price of your neighbor's homes, we'll call those the comps, comparing the price per square foot to account for control for size, and then make adjustments for other differences like a finished basement or an updated kitchen. So suppose in a particular neighborhood, the average price per square foot in the neighborhood is $150 per square foot. The range is $100 per square foot for, we'll call those fixer-uppers, and $200 per square foot, and we'll call those move-in ready luxury homes. The goal in this valuation exercise is you'd like to find maybe a luxury ready, move-in ready home at a low price per square foot, or at least verify it's fairly priced. Now, how does this compare for stocks? In the stocks, you might want to compare Walmart to its closest neighbors, or we call those competitors. And maybe then part of the problem is defining what those neighbors are, who those neighbors are or competitors. But let's say it's Target, Costco, and Amazon. We'll call those the comps. So we want to compare Walmart to those comps by comparing the stock price per dollar of earnings, the PE ratio. What that does is it normalizes or controls for profits per share. Now, just like price per square foot controls for the size of the home. You no longer have to look at the size of the home when you look at price per square foot. Well, if you look at a PE ratio, you don't look at profits anymore because it's controlled for that. All right, so what you want to do is then make adjustments for other factors such as the growth of the firm, the risk of the firm, the quality of management, the quality of the products. So just like you look at price per square foot of a home, then say, well, this one's cheap and has a nice yard and a finished basement, using PE ratio or price multiples, you would say, well, this one looks cheap, and by the way, I like management, I like the risk of the firm, I like the new product line. The key one is the PE ratio. PE ratio is just the stock price per share divided by earnings per share. Earnings per share are just the profits or net income divided by number of shares. And you would either use TTM, we call it trailing 12 months. That could just be the last 12 months of profits, or sometimes we just look at the prior year, so the last fiscal year. We also use the forward PE ratio, which is a forward-looking one, and the only difference there is you would use the earnings per share estimate for the next 12 months or the next fiscal year instead of the prior or 12 months or the prior year. And where do you get those? Well, Wall Street analysts have price targets, and they estimate EPS for the next year, so you use in Wall Street analyst estimates. So let's look at Walmart, Target, Costco, and Amazon. And our goal here is to try to think about valuing Walmart, or at least in this neighborhood, or these comps, who seems cheap and who's expensive. So what we have here is Walmart, Target, Costco, and Amazon. Here's their stock prices. But you can't just look at the stock price and say, oh, Amazon looks expensive. No, because the stock price is arbitrary. There's the value of the company, in billions, and then you divide by number of shares to get stock price. Well, some firms can have a lot more shares than others. Just like if you value an 18-inch pizza and cut it into 4 slices or 8 slices, the size of the slice really doesn't matter. It doesn't change the value. So that's the idea. You can't look at stock price and say something's cheap or expensive. At these companies, I'm looking at their net income, the number of shares. That gives me earnings per share. And then I was able to calculate trailing 12 months PE ratio, which is just the stock price divided by EPS. And what do we see when we look at those? We see that the cheapest is Target. That's controlling for profits per share. The most expensive is Amazon. So looking at this, I'd say Target is the fixer-upper, and Amazon is the premium move-in ready. When I look at the forward PE, so I just went on the web and asked for the forward PE of the stocks, it's the same pattern. Target is the cheapest. Amazon is the luxury move-in ready home. Now the idea is, okay, well, now I've controlled for those factors. I've controlled for profits. Now I'm looking at any other factor besides profit that would make me want to buy that stock. Again, the analogy to a home, you find a home that's cheap per square foot and then look at, well, it has a finished basement, it has a nice view, it has a nice yard, and so on. So I'm going to look at things like revenue growth, the DDE and beta, so measures of risk, the debt to equity ratio and beta, and why not the payout ratio? All else equal, I like a company that pays me out cash flows. But if the company's growing, well, maybe they want to keep the money and build. So when I now try to control, is Target a great deal? Meaning that I know it's cheap, and let's look at the growth. Well, the growth is it's actually better than Walmart, not quite as good as Costco, and a lot less. So it's not the worst growth. When I look at the debt and betas, well, it's a lot safer than Costco and Amazon measured by beta. It's got about the same debt to equity ratio as Target. So yeah, I don't know. So what am I left to do with this? Well, if I'm looking at Target as the cheapest company, it doesn't look terrible, meaning that they kind of have middling growth, and the risk isn't terribly high compared using beta. It's a bit high using debt to equity ratio. Now let's go back to our Walmart. What is Walmart telling me? Well, the average PE ratio for this set of comps is 30. Walmart is below average PE ratio, so it's on the cheaper side. But they do have the lowest growth, but they also have lower risk. So I'm not sure what to think about this. And this is often what's going to happen. You very rarely will find a situation, just like in residential home mortgages or residential homes, that you find the cheapest thing out there and it's clearly better. So this is where it leaves you. Here's another problem. There's not just one price multiple. There's a multiple of multiples. So I could have the trailing PE, the forward PE, the PEG, that's the price earnings ratio divided by growth. So say you have a PE ratio of 20 and you're growing by 10% per year. Take 20 over 10 and you get a number like 2. So the idea of the PEG ratio, and it's used a lot, they say it controls for growth, but it does in a linear fashion just by dividing by growth. You have the price per sales ratio, where you control for the level of sales. You have the price per book value of equity, if you believe in accounting rate numbers make any sense. This controls for the book value of equity, so that's the price of the stock over book value of equity per share. By the way, the price per sales ratio is the price of the stock divided by sales per share. And then you have things called enterprise value over revenue, but we won't talk about those for now. When I look at all these multiples, it's clear Target's cheap. Using trailing PE, forward PE, price per sales, price per book, and so on. The only one that Amazon stands out for is when you control for growth, Amazon actually looks like the cheapest. Okay, well, that tells me, well, maybe there's something into Amazon. Another thing you can use with these multiples is you can actually value a firm, come up with a target price or your valuation of the firm by choosing something like a PE ratio and applying it to their earnings per share. So for example, you might say that, well, when I look at Walmart, I think it should have an average PE ratio of these firms. So when I look at the average PE ratio of these firms, I saw that it was 41. And Walmart has earnings per share of 294. So if we take earnings per share times a PE ratio, you then get a price. And you say, well, I think Walmart should be worth 121 if they deserve a 41 PE ratio. So that's how you can use a PE ratio to value a firm. Just multiply what you think the PE ratio is that they deserve times the current earnings per share or next year's earnings per share. All right, so let's talk about one more thing before we move on. And that is price multiples are sometimes called relative value analysis. It compares stocks to the price of other stocks. What it cannot do and does not do is tell you in absolute terms it's a good investment. So it's just like comparing the price per square foot of a home in a neighborhood. it can't tell you whether all homes in the neighborhood are overvalued and they're about to fall. All it tells you is this one's cheaper than that one, but they both might be absurdly overpriced. So that's one problem with relative value or price multiples. Also, firms with negative earnings per share can't use a PE ratio because your E is negative. So in that case, you're then stuck with doing something like price per sales, price per book value of equity, or something like that. There's also important industry level ratios that people look at. So if you're looking at oil companies, you might look at price per share over oil reserves per share. So the idea is what creates value in this industry? Well, it's how much oil reserves you have. Or maybe look at price per share over unique monthly website visitors per share, because that's really what matters. Eventually, value will be derived from unique monthly website visitors. Or you can look at price per share over subscription members per share. So if you're comparing, say, Netflix with other subscription services, the idea is eventually the company is going to monetize that denominator, whether it's oil reserves or website visitors or subscription members. Eventually, that's going to create the value. So in this section, we talked about using or valuing firms or comparing firms using relative value analysis, and particularly the price earnings ratio, price multiple. In the next one, we'll actually value stocks using dividends, and then we'll value stocks using cash flows, and then we'll finish up a little bonus lecture on simulating correlated random variables. Can't wait for that.